slow. Whatever it does, it's a mistake. And the minute you talk about a Fed mistake, you talk about the possibility of a market accident, which feeds back onto the economy. So I understand why you got that sense of discomfort. It is a very uncertain environment right now.
The other sense of discomfort, as you know, is this issue in Ukraine. You're looking at the markets this morning, red across the board, and it is, as I think Becky said earlier, not Valentine's Day related. What do you make of the potential risk, and to the extent that investors should be thinking about it, how they should be thinking about it?
So Dom had a very good angle to this, which is what's happening in Europe. And the European markets are very worried. There's a significant risk off tone because of the impact on energy. Energy has one of the biggest stagflationary influences on an economy. And the last thing we need is another wave of stagflationary winds, if you like. So that is the concern. It's not just the geopolitics, because most people think that if, and I want to stress, if Russia does invade, it will be contained. It is what it does to energy prices and then the second round effects of that. And that's why Europe in particular is so sensitive to what's going on.
Hey, Mohammed, it's not just equities that are under pressure. Yields are coming down, too. Part of that being that this is a safety trade. You get worried about what's going to happen on a geopolitical front. Maybe you're more interested in buying treasuries. Yields at this point down across the entire spectrum, 2-year down a little bit this morning, too. What does this threat of a Russian invasion in Ukraine do to the Fed in terms of its ability to go ahead and raise rates as quickly as they'd like to? They've got to be looking at the inflation picture. How much does this kind of measure in as well?
Yeah, and Becky, if they were to look at 210s, that was under 40 basis points earlier this morning. It's about 41 basis points. Massive flattening. If they were to look at 710s, that's very close to inverting. So if the Fed were to take a holistic view of what's happening in fixed income, they would be worried that the market is pricing in a policy mistake. The market is pricing in a Fed that is too slow and then somehow ends up derailing the economic recovery. So it's really, really important. Now, what should the Fed do? Becky, it's very difficult for me to say that. I'm so glad you have Jim Bullard coming up, because the choices aren't particularly attractive. They've gotten themselves in this hole. Should they be bold to try to regain the inflation narrative and the policy narrative and risk to derail the economy and really undermine markets? Or should they go very slowly, be data dependent, be nimble, and find themselves in the trap of developing countries where you're chasing the market narrative all the time and you never catch up? That's where they are. If it were me, I would opt for slower rather than bold, but I would recognize that I am way far from the world of first best.
Mohammed, going slower, or really anything slower than, a hike every meeting this year, maybe a half point in March, might actually now qualify as a somewhat dovish surprise. I mean, that's how much the market has gotten ahead of steam up about the tightening expectations. Do you think that's the case?
So it would initially be viewed as dovish, and then people very quickly would realize that it doesn't solve anything. And that's why I stress that we have to recognize that having missed all the windows that were open to it, the Fed now doesn't have a first best policy. Look, I'd rather take that risk, Mike, than the other risk. I mean, it's incredible for me to hear that people who were in camp transitory 5 months ago are calling for the Fed to go 7 times this year, are going for the Fed to go 50. Some are even saying do an emergency hike. I worry whether the economy can absorb all this. This is an economy that has been conditioned, and markets that have been conditioned to function with very low interest rate and incredibly loose financial conditions. So we've got to be careful as to how the market reacts and how the economy reacts.
Hey, Mohammed, I talked to Steve Leisman about this in the last hour. One of the things I have heard out here all weekend is this idea that actually maybe the supply chain is actually getting a lot better than we think, much faster than we think. And in fact, that maybe inventories are quietly building up in places that we don't appreciate yet. If that's the case, that gets back to your transitory question or issue. Do you think that's real?
I think it's partially true, and I think it's one of the hope that you'll get an endogenous adjustment. The other hope is you get some other external event that helps us out. The reality is if you talk to a lot of companies, they'll tell you certain bits of the supply chains are getting better, but others aren't. Transportation is still a problem. There's pockets. And then labor. We've got to be laser focused on labor costs.
Mohamed El-Erian, we appreciate it. Ahead of this big interview with Jim Bullard, I know we'll all be watching it, as will you. We'll be talking about it with you very, very soon. Thanks.
Thank you.